Let's go, folks. Good morning. Welcome to the Street Today here from Post 35 on the floor of the New York Stock Exchange. Today is Thursday, the 19th of January. How are we already 19 days into it? Was just the holidays. Starting January 19th. I'm your host, JD Durkin. We're about an hour or so into the trading session on this Friday Eve, and stocks are trading lower as investors continue to digest comments from Fed officials signaling further rate hikes. We know the higher for longer campaign, it does continue. Investors are largely worried that the central bank will over-tighten, eventually triggering a recession. A lot of concerns along those lines for sure. Let's take a look for what is on tap for this morning's broadcast. We will talk Netflix earnings as the streaming giant gears up to release its fourth quarter results. We got that coming up later on today. Plus, we will bring you the latest on weekly jobless claims as that figure drops off. And finally, we will tell you what is going on. We'll try to tell you what's going on with Bed Bath & Beyond as the struggling company tries to dodge bankruptcy. We'll also talk a little crypto at the end of the show as well. For more on those stories and so much more, we now welcome in George Seay. George is co-founder and chairman of Annandale Capital, joins us from the great state of Texas. Hey, George, good morning.
Good morning, JD. Good, great to be with you.
Hey, it's great to have you here to help all of us try to make sense of what exactly has been happening. Obviously, you and I are having this conversation as the dust continues to settle on yesterday's big sell-off across the major market indexes. What is driving investor sentiment this morning, do you think? What are people waking up to and seeing for the first time on this Thursday?
They're really worried about the Fed. They're thinking the Fed is going to overshoot and is going to drive the economy into a deep, hard recession. And I think they're wrong about that. I don't think the Fed is going to overshoot. I think they're going to be aggressive early this year, but I think they'll back off later in the year. And people are very, very fondly hoping that the Fed will actually cut later in the year. I don't think they're going to do that. I think they're going to watch and wait for a while. But interest rates going up is bad for stocks, and that's what we've been dealing with the last year. And I feel like that a lot of the millennials and Gen Z folks who are in the financial services careers or in finance or investments in general haven't seen a market like this. So they're unfamiliar with what it looks like when the market goes down for a very long period of time. And that's what we're in right now. We're in a great recession or tech bubble bursting kind of market. And it's going to take a while to play it out.
Yeah, and especially for those younger first-time investors you mentioned, they're not used to playing the markets in an era where borrowing hasn't been at or near zero. I mean, this era of so-called easy money really dates back not just the last 2 years, as you know, George, it's really the last 13, 14 years or so. So certainly the rules of the game here are changing. I do want to ask you about comments from Fed officials that rate hikes will keep going. We also heard from Jamie Dimon at JP Morgan Chase this morning. He says, yeah, when all is said and done, that terminal rate will probably be north of 5% and will have to stay there because inflation is so deeply entrenched. How do you reconcile all this with seemingly weaker growth, declining corporate earnings, and of course, slowing inflation, not, deflation, but inflation at least starting to show that maybe it's headed in the right direction?
Yeah, it's a bad cocktail for the market, and it's going to take a long time to play out. I think that usually the market does what creates the highest level of pain for the largest number of investors, especially in a bear market. And I think what that looks like is a market that has a lot of volatility and basically goes nowhere for several years. You've got a lot of savvy investors who want the market to go down another 20, 30%, which would be really, really painful, but would create a great entry point for a lot of investors. And I'm not sure they're going to get that. I think they're going to get a soggy market that kind of goes up and down and up and down and basically goes a whole lot of nowhere. And people can't make a whole lot of money unless they're really, really savvy traders. And that would cause the highest level of frustration for the bulls and the bears both.
Now, as you and I are having this conversation, the S&P is currently at about 38.98. I think I got that right. Yes. We saw it. It obviously was tipping into 4K territory yesterday. We know what some of the guidance says. When you talk about potential buying levels, what are you following? Is there a key number, or to your point, are we in just such murky territory where we don't honestly know where that bottom potential buying opportunity will be in for people, especially for people who may have looked to kind of tax loss harvest at the end of December and are wondering when the opportunity is to buy back in on some of those names that maybe they sold positions for last month?
Well, that's a great question, JD, and that's why investing is difficult, and everyone's not a billionaire. It's very difficult to get this right. And you can make an argument you ought to be buying right now. You can make an argument you ought to wait till the S&P 500 goes under 3,000 to get much more reasonable pricing historically. So what we did last year is we started buying for our clients at 3,800 on the S&P. We bought at 3,600, and we were ready to get really aggressive if it got quite a bit below that. But if you get prices like that, it's kind of up in the air. You just don't know. So it's more savvy to kind of layer yourself in and not pick one particular price point to buy, because we really don't know how high rates are going to go and what the multiple on the S&P is going to look like. But I don't think we're done yet. I think we've got some more downside to work through. And the negativity that crept into the market after a really great start this year was a little bit surprising, actually. I was surprised the market started the year so strongly, and I'm surprised it's now going so weak so fast.
Was there anything in particular you think helped drive some of the selling yesterday? Was it PPI? Was it some key Fed comments that maybe kind of rattled a little bit of confidence? Because you're right, already we've had a tale of two different stories, right? We've got from where markets opened the first trading day of the year, and then it seems like yesterday starts to kick off a little bit of a different story. What do you think actually happened?
Yeah, anybody who thinks the Federal Reserve doesn't have an inordinate amount of power wasn't paying attention to Fed official Bullard yesterday. He said basically they're going to take it to 5 or higher, and they're going to do it. He thinks they should do it as fast as possible, because that tanked the market, that alone. One Fed official making one comment basically sent the Dow Industrials down over 600 points yesterday. And basically the market works inversely with interest rates, as we all know. The higher interest rates go, the lower the market's going to go, the lower the price to earnings multiple for the S&P 500 is going to go. And I would like the Fed to just be quiet. I'd love to see them just raise one more time aggressively 50 or 75 basis points and say they're done. I think that'd be great for the market and great for the economy both, but I don't think they're going to do that. I think they're going to leave it open and play out the year, and I think that's the wrong answer for the economy and the markets both.
So is your bet, if you had to make one for the February FOMC meeting, we're talking 25 and then maybe another 25 and then maybe another 25, as opposed to one big jumbo rate hike that I know you and probably lots of other people would like to see? Just rip the Band-Aid off, Jay Powell. Everyone's saying it.
We ought to just rip it off. We ought to go 75 and be done, and announce they're done for at least 6 months and see how the economy and everything else plays out. But they're not going to do that. I think they're going to do 50. The Wall Street wants to see 25 and see them kind of ratchet back down, but I think they're probably going to do 50. And I think that's what Bullard indicated yesterday, that they're not going to lighten up yet. And I think that's bad for the market and the economy both. It doesn't settle things rapidly. We need a rapid settling of monetary policy, and we're not going to get it, unfortunately, it doesn't look like.
Yeah, of course, a lot of the policies and the changes in monetary policy the Fed has instituted, part of the argument against continuing to raise rates is to say, let's just wait and see how the dust settles. A lot of this has not yet been felt by the market and the borrowing scheme as a whole. Let's just kind of wait and see how things settle. If you got to adjust later on, you make adjustments. But to your point, we did get those comments yesterday. And as we're having this conversation, just to do a quick market check, if you'll permit me to, the S&P is down, like I said, about 7/8. It's now at that 38.98 level. Tech-heavy NASDAQ down 9/10. The Dow 30 here trading down 7/10 as well, as we are about an hour and 8 minutes or so into today's session. George, we did get weekly jobless claims today. That figure was 190,000, a bit lower than expectations. People are still seeking unemployment benefits, we know, but is it happening at the rate that Fed officials want to see happen?
Yeah, I feel like the job market is incredibly strong, and it's why the Fed is being so aggressive, is the economy is stronger than I think Wall Street anticipates. The likelihood we get a really hard recession, I think, is pretty low. And I think the general consensus on Wall Street is it's pretty high. And I disagree with that. I think that the Fed could possibly engineer a soft landing. And one reason they're being so aggressive on rates is they look at the economy and the job market and say, wow, this continues to be strong and it can endure these accelerated aggressive hikes that we've been doing for the last year. And I think they're going to keep going on that until they get up well over 5%. So I think that's what the story looks like. And I think the one uncertainty that the market really hasn't figured out yet is, does the Fed start cutting later in the year? I don't think they're going to do that, and that's bad for the market. I think the Fed's going to hold their powder dry, but we'll see.
I mean, it does seem as if the market and the Fed are kind of on two separate tracks, right? It's almost as if a lot of investors don't seem to believe the Fed or Fed officials when they say we're keeping it higher for longer and we will keep rates at that elevated level. At some point here, something's got to give. And I wonder how you see that tension playing itself out. If it's not the Fed cutting rates, is it the Fed not issuing a mea culpa, but at some point saying, all right, we'll keep them higher for longer, but we won't necessarily keep raising them? At some point, is there just a jolt to the system when investors say, okay, yeah, we now have to believe Fed officials and take them a little bit more seriously? I mean, it doesn't seem like we're on the same page here, George. What am I? Maybe I'm missing something. So please tell me what I'm missing.
No, you're spot on. The Fed doesn't care about the market, and it doesn't care if it tanks it another 15, 20%. They're concerned about inflation. They think inflation is a huge adversary for the economy in our country. And actually, they're right. I mean, this is the first inflation fighting scenario we've seen in 40 years. And the Fed is basically resolutely, through Chairman Powell, said, we're not going to lose this fight. We're going to win. And if the market gets tanked in the process, that's just the way it goes. And investors have to deal with that. It's a grim reality. But for the next 6 to 15 months or so, we're going to have a workout period. And it's going to take time. But eventually we'll get to the other side. And then stocks will be a great buy going forward from there. But in the meantime, we're going to chop and we're going to have a lot of volatility. And there's going to be a lot of emotional sentiment up and down both.
Yeah, there certainly is, and it gives us no shortage of things to talk about. As you and I were talking about before we came on air, it is a really dizzying array of data points, many of which historically maybe we haven't put that much emphasis on, but in this unique facing all these unique cross currents of the economy, we put a lot of emphasis on every little data point to try and give us some indication about what officials at the FOMC will do, especially for February. We'll track that closely. George, I want to give you the opportunity. Is there anything I didn't ask either about the labor market or overall macro conditions that you think are important to talk about before we start to pivot? And I ask you a little bit about Netflix and some earnings expectations for the week.
Sure. I would just add, JD, for your listeners, that we've really got a problem with margins for companies and for price per earnings multiples and earnings expectations and earnings comparisons to the past, because inflation is running through the system and is squeezing margins, and a whole lot of companies are going to make numbers comparatively to the past, poor comparisons, and going to disappoint the market, and it's going to be a headwind against stocks going up in the future. So we're going to have to really watch that over the next 3 to 15 months, because it's going to be a hard season for these companies dealing with their margins being squeezed and trying to report earnings that the street's excited about. The street's going to have the opposite reaction to that, and it's going to be a real headwind for stocks. And I think it's going to be a working out period. I don't think earnings are going to collapse like a lot of people do, but they're going to get squeezed, and comparisons are going to be harsh, and investors aren't going to like it. And it's going to take time for us to work through that.
Absolutely. Okay. Well, thank you for that context and perspective. It's always important. Now, of course, we are covering earnings, and of course, one of the big names after the bell we are expecting is Netflix. And we always cover that space very closely. We know that the last couple of quarters, in terms of subscriber growth and a few other metrics, started to trend a little bit of an unexpected direction. Maybe this is now a continuation of them trying to right the ship a little bit. What are you expecting from Netflix when we hear from them later today?
Yeah, I think Netflix is an old story. We shorted some puts on Netflix below $200 a share, and we were long the stock for a while. And I think it's going to muddle through here in the future. I think that the era of Netflix posting five times growth in terms of its stock price, where it goes up and up and up and up, is over. I think it's a mature company, and I think the multiple is going to get reassessed by the street. And I think their new ad offering is going to be very complicated and messy in terms of rolling it out and how it goes forward. And I don't think it's a very attractive stock with the great rally it had off the bottom last year. I think it's going to kind of muddle through in the future. And unless you're a value investor and you buy it really cheap when it's out of favor, I don't think there's a great story here.
Yeah, the stock is trading down right now. It is at the 323 level, which means it's down about 7/10 or so, at least to kick off today's session ahead of earnings there. You mentioned that $6.99 ad-supported subscription, something different that they're trying to roll out. I mean, even personally, are you a Netflix fan? And if not of Netflix, as a user in your own household, I'm sure you're familiar with the ad subscription space for a lot of their competitors. Is it an impact you think is really going to be a step in the right direction? Or is it perhaps just a bit too soon to tell?
I think they're way late with this offering. They should have done it a long time ago. I'm definitely a Netflix fan and subscriber, but I'm not going to pay. I'm not going to do the ad route for sure. I don't enjoy ads, and I think a lot of consumers feel the same. And I think it'll improve their financial profile, but I don't think it's going to be as big a sea change as Wall Street would hope it would be for the stock and the company. And like I said, I think it's a mature business that's kind of topping out and is not as attractive as it was in the past.
I mean, if you don't mind me asking, outside of Dallas Cowboys football games, what does George Seay watch, either on Netflix or anything else? What is playing in the Seay household these days?
1923, the new Yellowstone spin-out with Harrison Ford and Helen Mirren. It is spectacular. It's really, really good. So if it's good TV, we're watching. If it's bad TV, we're trying to avoid it.
There you go. And I know you certainly hope that, at least in terms of the football offerings this weekend, that it's good TV in terms of how the Cowboys perform against the 49ers. That's going to be a heck of a game. Let me ask you about Procter Gamble here. That company reporting year-over-year declines in its second quarter. How's that company contending with surging inflation? Any thoughts there on Procter Gamble?
Same comment specifically to Procter Gamble that I made for the overall market. They're having a major margin issue in terms of having their margins squeezed by all the inflation running through their cost of goods sold and everything they're doing in their pipeline in terms of their vendors and people who supply them for their products. And Procter Gamble is a great company for widows and orphans and pension funds and all that, but it's a very boring, slow-growing, blue-chip way to play the market. For anybody who wants growth or wants significant returns on capital, you're better off finding other stocks or just investing in an index fund, the S&P 500. It's a great company for people who want secure, steady growth and a lack of volatility, and that's going to be the case going forward. It's just a giant. It's so big.
George, people are asking questions. They're looking at their portfolio, wondering who are the recession-proof names. You view P&G as one of those names, and if not, are there others that come to mind, I wonder?
I don't know, JD, if anything's recession-proof, but it's pretty close. And I would put Walmart in that category, and I put Costco in that category, and a lot of the really outstanding Home Depot, Johnson & Johnson, blue chip names that are going to be here forever and are going to grow irrespective of what the economy's doing. It may be a slower level of growth, but people are going to flock to those names for safety in times like this. And but they're few and far between. Most of the market is very exposed right now. And I don't think that the carnage in the tech space is over yet. I think there's more to come there. And I think people are overly optimistic and bidding up some of the tech names right now. I think this is going to, we've been in this market for about a year now. And I think we've got at least another 6 to 18 months left to go before we work ourselves out of this.
To the point about earnings season more broadly, if you don't mind me asking, obviously, we've gotten through the big financial names, a bit of a mixed bag. We know the story with Goldman earlier in the week, especially here. What are some of the most important figures to be paying attention to? And I wonder, since I know you have to be a consumer of business news, is there anything, especially during earnings season, you think that those of us in business media miss, or maybe we put the priority on the wrong thing? I mean, what really stands out to you that you would want someone watching the show right now to keep in mind as earnings season rolls along?
Boy, what a great question. I would say that I think we're in a commodity super cycle. I think that we're not doing enough CapEx to have adequate supply of natural gas and oil and other commodities. And I think that in the next 2 to 5 years, that's going to really hit home and drive commodity prices a lot higher. And I think that's one reason the Fed has been so vigilant on inflation and raising rates, is they realize that's a real threat to our economy and the rest of the world as well. So I think that would be something to watch very, very closely, that effect on corporations and U.S. GDP and earnings growth and so forth and so on. That's good for commodity stocks. It's bad for everybody else. And we've gotten a respite from that in the last 3 or 4 months because commodity prices have gone down significantly because of excessive natural gas supply, because we don't have LNG capacity in place yet, but we will next year. And with the Biden administration's war against oil prices, where they've emptied the strategic petroleum reserve and are trying to do everything they can to run down oil prices. But that's going to expire here in the next 6 to 12 months. And you're going to have, I think, a 2 to 4 year super cycle in commodity prices and because of the lack of adequate supply. And investors should really look at that because that's really bad for everything but commodity stocks. So that's what I would pay attention to.
Yeah, George, we know the story with the big tech stocks, the big tech names, these huge growth companies over the course of the last few years. It's been a fundamentally different story here the last few months after facing one of their worst years in recent memory. What are you expecting here for tech earnings as we continue? Obviously, we talked about Netflix, but we got a lot of other big names that are on tap, and people are remembering once upon a time, not that long ago, 2020, they said, my goodness, look at my portfolio, whole splashes of green everywhere with these names, and that has not been the case recently.
Well, you look at Microsoft, for instance. I own Microsoft. I'll always own Microsoft. The CEO sold half his stock position late in 2021, which was a great indicator that he thought that the timing, it was overpriced and the timing was good to take some chips off the table, and it's been a terrible performer last year. Microsoft, investors forget, from 2000 to 2017 basically went nowhere. It went down really hard initially and then was basically the same price in 2017 that it was in 2000. And I'm not saying that's going to happen again in tech, but I do think tech has got a real workout period ahead of itself. Both the blue chips and the more speculative early stage companies. I like Snowflake a lot. I think that's a great company and they're growing at a spectacular rate. But do you pay 20 times sales for Snowflake where it's trading right now, or do you pay 10 times? I don't know, but it's probably not 20 times. So I think these companies have got a lot of workout going and they've got to grow into their stock price, and that's going to take time. And I think investors don't have the patience for this, and eventually you're going to have another significant sell-off because investors just don't want to sit around and wait for their 30, 40, 50% annual gains like they were getting the last 3 or 4 years before this bear market hit. They just don't have the patience for it. And they're going to have a hard lesson here in the next couple of years, I think.
Absolutely. All right, that's George Seay, co-founder and chairman of Annandale Capital. George, I wish you and the Dallas Cowboys luck, but only insofar as I would love to see a Cowboys-Giants NFC Championship game. My man, enjoy the weekend, enjoy the game, and thanks for the great perspective today. I hope you'll rejoin us at some point in the future.
Thanks, JD. Appreciate it. Go Giants. We want to play you Giants.
Let's go. We'll take it all day. George, thanks a lot. Good to have you here. All right, folks, coming up, we will be bringing you here the latest headlines on Bed Bath & Beyond's rescue plan. Plus, we will tell you the latest crypto firm to declare bankruptcy. Of course, the FTX collapse continues, and it's taken a lot of names with it. And finally, we'll give you an update here soon on the housing market as new home construction continues its decline. But first, we recently sat down with Wall Street's most famous trader to discuss his new NFT collection, though I should warn you, NFT does not necessarily stand for what you think it stands for. Take a look. The great, the one and only, the institution himself, Mr. Peter Tuchman, known to many, millions probably around the world, Einstein of Wall Street. Thank you for being here. Congratulations.
Thanks, JD. Good to have you.
Big release coming up. I know people are familiar with the letters NFT, but for you, it means something a little bit different, doesn't it?
Yes,
What is
it
it?
does.
What are we talking about?
I'm not liking the connotation. A lot of people have a bad thing around crypto and the non-fungible token. So what we are launching is a non-fungible Tuchman. It's the first and one only on Earth. It is basically an incredible array of artwork that was done. Like NFTs historically are basically beautiful generative launches of large bits of artwork. This is going to be artwork that is basically me riding a bull and a bear with different rarities out front of the NYSE. And basically it's a non-fungible Tuchman. What does that mean? It's basically going to be an access pass to me, to my experience and my strengths and my sort of motivation and inspiration as a broker and a trader here, what I've learned about how to navigate the market successfully. So I figured I've been trying to get people's attention with live free webinars, with all my social media and whatnot. And I think we're here in 2023, and it's been a bit of a topsy-turvy couple of years in the market. I kind of just want to give everybody in the community, this new generation coming in here, who maybe didn't get the memo, the playbook and whatnot, how to do this successfully, that it's not about gambling or getting rich quick. It's about giving you a toolbox, filling it with tools, and giving you the probability that you'll make money more times than you're not. We do have losing trades. You know, there is obviously problems trading this market. It has been,
Sure.
as you know, you talk about it all the time, it's been some of the most challenging times ever. But I think education is the best defense against a rug pull or a scam or anybody being given information that may not really have their best interest involved. If you learn the game, if you learn technical analysis and risk management, then you've done your due diligence, you've done your homework, then you'll be able to figure out how to get involved.
And patience is a big part about that as well.
You
So
love
talk to me
patience.
before.
Yeah.
Well, it is a big thing because you talk about the get-rich-quick schemes, and people see the numbers that are posted on, this forum or that forum. Oh, this person invested that, hey, and 48 hours later is able to cash out, and that is not representative of the real investment experience. Before we wrap up, talk to us about some of those big things. Are there questions? Are there mistakes? Are there misconceptions people are coming to you and David with that you repeatedly see that is important for you through the lens of education, as it pertains, of course, to the release you're doing this week?
You know, it is really a great question. So the mistakes that unsuccessful day traders are making are all the same. Okay, they've been given a story that's not really sustainable in the market. They trade on FOMO, fear of missing out. They trade on hype. They trade on big volume bursts. They think that listening to the internet and Reddit and whatnot are great trading strategies. They're not sustainable. right? Listening to people who give you targets. We've seen a lot of bad actors in that space. People who create these large communities and do the old Jordan Belfort pump and dump. So the problem is that people love to average into trades. If you're averaging into a trade, you're in a bad trade. People need to figure out the target. There are rules. We're calling them the 10 commandments of day trading, that are things that actually work, that they've shown that they are sustainable trading strategies. Look, you don't win all the time. It's a probability game. It's a numbers game. So I want people, you've all been invited to this party after 100 years of barriers to entry trading the market. Anybody with $100 in an iPhone can now trade the market. But you need to read the memo, get the menu, see the playbook, and access to our EinsteinofWallStreet.org, EOWS.org. This access pass will give you a probability that you may be able to become successful trading this. And I appreciate the opportunity to tell your audience about it.
Of course. And finally, I know we don't have one here. Is there one specific design that you're most excited about? One that you sit there and say, oh man, that one turned out way better than I even thought. I got to imagine it's you in a bull.
It is. So you know what? I'm riding a bull and I'm carrying my basketball, which I always carry around.
Yeah.
And I've got a really cool Dow 40,000 hat, so
Nice.
it's sort of looking positively
like
to the
that.
future. And I'm riding a bull out front of the exchange, and it's great. But you know what? The artwork is incredible. You're all going to love that.
Yep.
At least you're going to have some fun artwork, and you're surely going to learn something along the way.
Congratulations, best of luck, and thanks
you.
for taking the time for us.
EOWS.org.
To look for it.
Everybody go check it out. There's a link in my Instagram bio.
There we go, the
You're
one and
all
only
welcome.
Mr. Einstein. Thank you for being here.
Thank you, sir. Pleasure.
Non-fungible Tuckmans. My special thanks there to Peter Tuckman, known worldwide, I guess I'll say worldwide, as the Einstein of Wall Street, the most photographed trader in the history of the NYSE. He's a good friend of ours here at The Street. My special thanks to Peter for taking the time. Let's now get you caught up on some of the biggest stories moving markets on this Thursday morning. And of course, we begin with BBBY, Bed Bath & Beyond, facing a likely bankruptcy filing and is in talks with potential buyers, according to CNBC. A spokesperson saying this week, quote, multiple paths are being explored and we are determining our next steps thoroughly and in a timely manner. This as the retailer seeks ways to keep both its Bed Bath & Beyond stores and its Bye Bye Baby stores open. Simultaneously, the company is also looking for a lender to provide financing to keep the company afloat if it were to file in the coming weeks. Bed Bath & Beyond continues to contend with bad news. The company recently began another round of layoffs, and the stock is down 71% in the last year. Next up, the bad news keeps mounting for crypto, with yet another firm preparing for bankruptcy. Crypto lender Genesis is reportedly in final stages for Chapter 11 bankruptcy. This according to a report from Bloomberg. According to that story, Genesis has been in talks with creditors since November, to whom they owe over $3 billion. The company also slashed 30% of its own workforce earlier this month in a bid to cut costs. If it goes through with the filing, Genesis would be just the latest casualty of the FTX collapse and broader decline in the cryptocurrency space. And a bit of fresh data out in the housing market earlier today. New home construction slipping for a fourth straight month in December, capping off what has been a pretty brutal year, to say the least, for the housing market. It, of course, saw housing starts decline for the first time in 14 years. According to the U.S. Commerce Department, construction on new homes slipped 1.4% last month to 1.38 million. That marked a 5-month low. This decline comes as construction costs and interest rates continue to rise. And that, my friends, is going to do it for a bit of a new look version of The Street Today. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.